If you're in your 50s and your 401k lets you choose between a Roth and pre-tax, it can feel like a big decision. You may be wondering whether you should switch everything to Roth or just keep everything in pre-tax or do a little bit of both. And it can get really confusing because you'll hear a lot of people out there saying a Roth account is always better or a pre-tax account is always better. Today I want to show you how to use your tax bracket as a way to manage paying less in taxes over your lifetime, not just in one particular year. Let's just do a quick refresher on the difference between pre-tax and Roth. So a pre-tax account lowers your taxable income today. You're getting a deduction by making a contribution into that account, which will lower down your taxable income today. Once it's in the account, it grows tax deferred, which just means that every year you're not getting taxed on the growth that's occurring in there. Later down the road, when you pull money out of the account, you're taxed at that time. And the reason for that is it's a retirement account. So the idea behind it being that you're gonna pull funds out of the pre-tax 401k down the road. And when you pull it out at that time, it is taxable income to you. So just like income from your job, once you're pulling that out in retirement, it's taxable ordinary income to you. Now, a Roth, on the other hand, you're getting no tax deduction today. So you're getting taxed on it essentially today when you're making contributions. Once it's in the Roth account, it grows tax-free. So every year, you're not being taxed on it, but when you pull money out down the road, all of your withdrawals are tax-free, assuming you meet some basic criteria. I won't get into what all that criteria is, but essentially the Roth account is designed to be a retirement account, so there's certain boxes you have to check in order to be able to get that tax-free status. So you have to meet those in order to have it be tax-free withdrawals. So the real question is, once you're in your 50s, or you could be in your 60s or 40s, but let's just focus on someone in your 50s, which account is better? So to answer the question, the best way to look at it is not which account is better, but it's at which tax rate do you want to pay on the dollars that you're putting into the account? Do you want to pay taxes at the tax rate you're at now, or do you want to pay taxes at the tax rate that you'll be at later when you're in retirement? So that's hard to know, but what you can do is something called bracket management. Now, bracket management is based on what our tax system is, which is it's a progressive tax system where as you make more and more money, you're taxed at higher and higher rates. It's various steps. So every time you move up, you're moving into new brackets. So your first tax dollars are taxed at lower rates, and as your income goes up, each extra dollar hits a higher step and hits a higher bracket. So what bracket management is simply choosing when to recognize income so that it lands in a particular bracket rather than another one. So if you're in a high income year, and usually your 50s are just statistically some of the highest income earning years that people have, now might be a good time to consider the pre-tax version as a way to reduce down your taxable income and get that deduction in a high income year. And it's a little bit of a game because you don't know for sure what your tax bracket will be in retirement. But you do know that you're in one of your higher income tax years this year. And I would say that if it's, by and large, one of the highest income years you've had throughout your career, then there's a good chance that you're going to be wanting to take that deduction and that your income's going to be lower in retirement than it is now. It's not guaranteed, but it's a good rule of thumb. So if you're in a high income tax bracket this year, or it's been one of your higher earning years, it's definitely worth considering just getting that deduction now while you know your income is high. Because you don't know what's going to happen in retirement. You don't know what your income is going to be. You can get projections and you can get estimates, but sometimes it's better to have that certainty of getting a deduction in a high income year rather than trying to project and estimate that you'll get a bigger deduction down the road. So if you are making that decision, here's a 3-step exercise that you can do to decide between the two. First, figure out where you are today. Are you in a relatively high tax bracket right now? Do you have dual incomes? Are you and your spouse both working? Are you in peak earning years? Has your income been at high points anytime recently compared to the rest of your careers? Have you been getting big bonuses or restricted stock or other awards that may be impacting your taxes? So every dollar during the high income years that you're putting into Roth, you are having them taxed at a higher rate. The second thing I would think about is, do you see a low income window coming up at any point in the future? Do you have a year where one or both of you are going to be working less? Do you see a point where one of you will be making a lower income, perhaps switching jobs or something like that? Is one of you considering retiring in the next few years to where you're just going to drop down to a single income? Are you going to have some years before claiming Social Security where you think your income is going to be a little bit lower? All of those times where your income may drop, that may be a case to be switching to more of the Roth contributions. So you see what I'm saying? Whether you have a high income or low income relative to your other years of income is a big factor in what determines whether to do Roth or pre-tax. So the third step is to simply match your 401k to the phases that you're in. While income is high, it often makes sense to lean pre-tax. When you hit those lower income years, you may want to switch more of the contributions to Roth. And if you have windows where you're not working and can't make contributions to a 401k, those are the years to consider Roth conversions. I'm not going to get into everything with Roth conversions, but it's a way that you can move money into a Roth in low income years where you're also not working and able to contribute to a Roth directly. So hopefully that helps give you a little bit of a clearer idea of which one you should be going with. If you'd like for me to take a closer personalized look at your own situation, you can schedule with me via the link in the video description. Thanks as always for watching, and I hope to see you in another video.